On February 6, Bitcoin crashed from 70k to 60k within 4 hours. But an AI sentiment model just detected this panic selling just 72 hours before it happened. Now the institutional playbook is entirely changed. Currently, high frequency algorithms are predicting the social media sentiment faster than you can refresh. And they can front run panic selling by milliseconds. And today we are reverse engineering how the AI just predicted the February 6th panic selling, and that 3 sentiment signal just appeared 72 hours before the crash. And this is super important to protect your portfolio, where you can identify how the liquidity evaporation will work. This is not a hype-driven video. This is actually the data-driven flow that we are discussing here. Between February 5th and 7th, the crypto market saw around 5.4 billion in liquidation cascade. Not 5.4 in selling, it's literally 5.4 billion in forced liquidation. And this difference is actually matters here. 586k traders are just liquidated in this situation, and 93% the positions were long positions, and there was a single most biggest long position that was around 36.7 million Bitcoin long on Hyperliquid, and that evaporates in seconds. And here is the uncomfortable truth: the AI sentiment models just started to flash red in the February 3rd, a full 72 hours before the cascade. And how they identify this pattern? They identified 3 anomalies. Let's discuss each anomalies one by one. Anomaly 1, the credibility score collapse. The AI sentiment platforms just track around 10k crypto influencers and assign them a credibility score by using the historical accuracy. Between February 2nd and 3rd, the influencers with score above 85, the smart money voices, flipped bearish. Their aggregated sentiment just flipped from plus 48 to minus 18 in 36 hours. And the algo just detected this index without any noise. And anomaly 2, the hodl desperation index. The advanced NLP models like crypto LLM, a fine-tuned models using millions of crypto tweets, and this can detect fear distinguished as a conviction. When hodl mentioned spike around 347 percentile on February 3rd, while Bitcoin was still at 78k, AI flagged this as a capitulation language, not the conviction hands. Anomaly 3, the funding rate divergence. The perpetual funding rate just fell from minus 20 percentile to minus 35%. When AI just cross-checked this with social sentiment, that's actually negative, and it is identified this as a trap long scenario. And this model just predicted that there is a high probability of cascading of liquidations within 42 to 72 hours. And let me show you where this thesis will break, like how I will be wrong in these theses. There are 3 scenarios here. 1, the institutional bid wall will return at 60k. If Coinbase premium, the price difference between Coinbase and Binance, that flips positive and that hold around 72 hours. This means US institutions are accumulating. The AI model will weigh this heavily. And 2, the funding rates normalize about 10 percentile. If shorts start skews, and long will re-enter without any panic on social media. The sentiment price feedback loop reverses here. 3, the fear and greed index holds about 25 for 5 consecutive days. It literally hit 5 on February 6. This is the lowest since the fear index launched in 2023. But if it stabilized above 25, it signals that deleveraging is already completed. Right now, none of these conditions are met. Market depth is still 70 percentile below the October levels. This is not a recovery, this is actually fragility. Now let's talk about the one chart that will prove this is wrong. High frequency trading firms execute trades within 500 milliseconds while they see any sentiment shift. Not 5 minutes, it's literally 500 milliseconds. Here's the playbook. Sentiment algorithms scrape Twitter, Reddit, Telegram, and Discord and fill 50k messages per minute. They run this through Finebird, a financial sentiment AI model, which output a score from -1 to +1. They won't trade on all sentiments, they trade on credibility weighted sentiment. A tweet from the Vitalik Buterin gets a weight of 100. On other perspective, a random bot gets literally 0.1 credibility. During this February crash, the algorithm detected 3 things simultaneously. The high credibility influencers are turning bearish. The retail hodl desperation languages are spiking. The funding rates are signaling there is a trapped longs here. The AI didn't cause this crash, but it front-run the panic by 72 hours. And this allowed institutions to hedge their positions, tighten the stop losses, even the profit from this liquidation cascade. The IMF released a report on October 2024 warning that AI-driven trading will increase the market volatility, They found that when multiple algorithms see same pattern in market sentiment, they will create a selling spiral. Each algo trigger the next algorithm, and this will amplify the move. Between 2:41 and 2:44 p.m. Eastern Time, Bitcoin dropped around 3% in 4 minutes, and the pattern matched the 2010 flash crash like almost perfectly. Algorithms started a hot portfolio effect, passing positions back and forth. Each exit triggered the next liquidation. There are three weighted probabilities we created for Q1 2026. First case is bear case. There is a chance of around 50% probability. Bitcoin will retest 60k and potentially breaking 52k if institutional ETF outflow continues. The AI sentiment models are still bearish weighted. And what will be the trigger for this? Maybe another credibility score collapse or a macro shock like a Fed policy error or a geopolitical escalation. And next is the base case. It has a 30% probability. In this case, there should be a choppy consolidation between 65 and 80k. In this case, sentiment will stabilize but doesn't flip bullish. The market depth will slowly improve but remain fragile. This should be a wait and watch scenario. And next is bull case, like 15% probability. The institutional buy will defend the 60k and the funding rates will normalize and sentiment flips within 2 weeks. In this case, Bitcoin will reclaim like 85k March by end of March. This is actually a low probability scenario, but the February 6th recovery of 60k to 70k in 12 hours prove that bid is still there. For your portfolio, if you are still holding cash for the 20% positions, you already got it right now. If you are fully deployed and over leveraged, the AI models are suggesting you are in a danger. The flaws don't lie here. If you really want to understand how the institutions are using AI to front end the retail, the next video will break down the exact Finbert model they are using, and we will discuss how you can use it for free. And let's talk in the comment, are you holding for a deeper correction or you already deployed everything? See you in the next video.